Picture this. You spot the perfect setup. Clean breakout. Strong volume. Every indicator aligned. You click buy at $50 even. But your order fills at $50.12. Next trade, same story. Different stock, same slippage. By month's end, these invisible pennies have bled you for thousands. You tell yourself it's just bad timing, market volatility, the cost of trading. But deep down, something feels wrong. Like someone's watching your screen. Like the market moves against you the instant you commit. You're not paranoid. You're not unlucky. You're being hunted. According to industry estimates, high-frequency trading extracts over $20 billion annually from retail traders through systematic latency advantages. That's not a market inefficiency. That's a design feature. Welcome to Trading Psychology Stick, where we expose the hidden mechanisms that turn your trades into someone else's profits. Tonight, we're investigating one of finance's best-kept secrets. Not a conspiracy theory, not market speculation, but documented fact, hidden in SEC filings, court transcripts, and academic research. This is the story of how Wall Street weaponized time itself, how a handful of firms built invisible toll booths on every trade, and how one man's discovery sparked a revolution that's still unfolding today. What you're about to learn isn't taught in any trading course. The firms profiting from it pray you never connect the dots. But once you see the pattern, you can never unsee it. This is the Millisecond Heist, and you've been paying the tax your entire trading career. Chapter 1. The Glitch in the Matrix. Brad Katsuyama had everything a Wall Street trader could want. Corner office at Royal Bank of Canada, 7-figure salary, respect from peers. But in 2007, something started bothering him. Something small, almost imperceptible, but impossible to ignore once noticed. His trades were slipping, not dramatically, just consistently. He'd see 10,000 shares available at $25, click to buy. But by the time his order executed, only 2,000 shares remained at that price. The rest vanished, like they were never there. At first he blamed himself. Maybe he was too slow. Maybe the market was just volatile. But the pattern was too consistent, too surgical. It felt less like bad luck and more like theft. Brad started documenting every trade, timestamps, order sizes, execution prices. The data revealed something disturbing. The slippage wasn't random. It correlated perfectly with his order size and the number of exchanges he was accessing. The bigger his order, the worse the slippage. The more venues involved, the more prices disappeared. He wasn't alone. Traders across Wall Street were experiencing the same phenomenon, but most dismissed it as market noise, the cost of doing business in electronic markets. Brad couldn't let it go. His engineering background demanded an explanation. Markets don't just break in perfect patterns. He assembled a team, programmers, data analysts, market structure experts. Together, they began dissecting every millisecond of their trades. What they found changed everything they thought they knew about modern markets. The stock market wasn't one place. It was 13 public exchanges plus dozens of private venues, all slightly out of sync. When Brad placed an order, it didn't reach all venues simultaneously. It arrived at the closest exchange first, then rippled outward at the speed of light through fiber optic cables. That tiny delay, measured in millionths of a second, was enough. Someone was seeing his order hit the first exchange and racing to buy shares at all other venues before his order arrived. They'd then sell those shares back to Brad at a higher price. It was arbitrage, but not the kind taught in textbooks. This was predatory, systematic, and completely legal. The revelation hit Brad like a thunderbolt. The market wasn't broken. It was functioning exactly as designed. Designed by and for those fast enough to exploit these microscopic time differences. Everyone else, they were the product being sold. But who was fast enough to play this game? And how much were they willing to pay for speed? Chapter 2. The Physics of Profit. To understand the heist, you need to understand the weapon. Latency. The time it takes information to travel from point A to point B. For you, clicking buy feels instant, but instant is relative. Electrical signals through your computer, data packets through your internet connection, order routing through your broker's systems, processing through exchange servers. Each step adds microseconds, and in modern markets, microseconds are worth millions. Here's what actually happens when you try to buy Apple stock at $100. Your order reaches the nearest exchange, say NYSE, in 30 milliseconds. But NASDAQ is 40 milliseconds away. BATS is 35 milliseconds. By the time your order reaches all venues, high-frequency traders have already seen your intent and adjusted prices accordingly. They call it latency arbitrage. Here's how it works in practice. A high-frequency firm's algorithm sees your buy order hit NYSE. In less than a microsecond, it calculates that you're likely trying to buy across multiple venues. It immediately sends orders to all other exchanges, buying up available shares. When your order arrives milliseconds later, those shares are gone. The firm offers to sell them to you at a slightly higher price. You lose pennies per share. They make pennies per share, multiplied by millions of shares, millions of trades, every single day. According to a University of Michigan study, latency arbitrage generates over $5 billion annually. Not by being smarter, not by taking risk, simply by being faster. The truly insidious part? This isn't a bug in the system, it's the business model. Exchanges sell speed advantages, brokers sell order flow, technology firms sell faster connections. Everyone profits except the actual investors. Consider this. Light travels through fiber optic cable at roughly 200,000 kilometers per second. That means every 200 kilometers of distance adds 1 millisecond of delay. In a game measured in microseconds, geography becomes destiny. If your broker's servers are in New Jersey and you're trading in California, you've already lost. Not because of your strategy, because of physics. But some firms weren't content with physics as it existed. They decided to reshape it, to bend the very infrastructure of communication to their will. What they built next would cost hundreds of millions and save mere milliseconds. To normal people, that sounds insane. To high-frequency traders, it was the deal of the century. Chapter 3, The Tunnel That Broke Time. Dan Spivey had an idea that sounded like science fiction. Build a fiber optic cable from Chicago to New Jersey. Not just any cable, the straightest possible cable, through mountains, under rivers, across private property, whatever it took to shave milliseconds off communication time. The project, called Spread Networks, would cost over $300 million. The goal? Reduce latency from 17 milliseconds to 13 milliseconds. 4 milliseconds. Less time than it takes a honeybee to flap its wings once. Wall Street thought Spivey was crazy until they did the math. Chicago hosts the futures market. New Jersey hosts the stock exchanges. Information travels between them constantly. Futures move first, stocks follow. If you could see Chicago prices and react in New Jersey before everyone else, you'd have a 4-millisecond window to print money, every single second. The construction was an engineering marvel and a legal nightmare. Spread networks needed rights of way from hundreds of landowners. They drilled through the Allegheny Mountains. They laid cable across rivers. They fought environmental reviews and local opposition, all in secret, because if competitors knew, they'd build their own cables. The route had to be perfect. Every unnecessary turn added microseconds. Every extra mile meant lost profits. Engineers used GPS and terrain mapping to plot the theoretically shortest path. Then they made it reality, meter by painful meter. When Spread Networks went live in 2010, it changed the game overnight. Firms paid millions just for the right to connect. Trading strategies that relied on the 17-millisecond delay suddenly stopped working. A new arms race began. Who could process Chicago information and execute New Jersey trades fastest? But the cable revealed something darker. The fact that firms would spend $300 million for a 4-millisecond advantage proved how much money was being extracted from slower participants. Every pension fund, every mutual fund, every retail trader, all bleeding money to those 4 milliseconds. The market had been turned into a pure speed game, not speed of thought, speed of light. And the admission price kept rising. Brad Katsuyama watched this arms race with growing disgust. The market was becoming an engineering contest, not a capital allocation mechanism. The fastest firms weren't adding value. They were extracting it, parasites optimized down to the microsecond. But the cable was just physical infrastructure. The real weapons were algorithmic, and their most powerful practitioner was about to make a fatal mistake. Chapter 4. The Algorithm Uprising. Sergey Aleynikov was a programming genius. At Goldman Sachs, he built systems that turned market data into profit with supernatural efficiency. His code could analyze millions of price changes, detect patterns invisible to humans, and execute trades faster than conscious thought. In 2009, he received an offer he couldn't refuse. A startup promised to triple his salary, better work-life balance, more interesting technical challenges. On his last day at Goldman, Sergey did what programmers often do. He copied some code to his personal email, code he'd written, code he wanted to reference at his new job. 8 days later, FBI agents arrested him at Newark Airport. The charges were theft of trade secrets. Goldman Sachs claimed the code was worth hundreds of millions. Prosecutors painted Sergey as a dangerous thief who'd stolen the keys to the financial kingdom. But during the trial, something extraordinary slipped out. An FBI agent testified that Goldman's code could be used to manipulate markets in unfair ways. The prosecutor quickly clarified that Goldman itself would never do such a thing. But the damage was done. The public had heard the truth. The algorithms making billions for Wall Street were, by the government's own admission, capable of unfair manipulation. Think about the implications. Every day these algorithms execute millions of trades. They see order flow before it happens. They detect patterns in human behavior. They exploit infrastructure advantages. And they're so powerful that their mere theft warranted federal prosecution. Sergey spent a year in federal prison. His real crime? Taking code that Goldman used daily to extract profits from market inefficiencies they helped create. The irony was staggering, like arresting someone for stealing tools that were themselves used for theft. The case revealed high-frequency trading's darkest secret. It wasn't just about speed. It was about seeing the matrix of the market, about algorithms sophisticated enough to predict human behavior and trade against it, about systems so complex that regulators couldn't understand them, let alone control them. These weren't tools for price discovery. They were weapons for price manipulation, designed to create the illusion of liquidity while extracting maximum profit from genuine orders. Your orders. But algorithms were just one piece of the puzzle. The real money required something else. Darkness. Chapter 5. Swimming in dark pools. Imagine a stock exchange where prices aren't displayed, where orders are invisible, where buyers and sellers trade in complete darkness. Sounds like a recipe for manipulation, right? Welcome to dark pools. Originally, dark pools served a legitimate purpose. If a pension fund needed to buy 10 million shares, advertising that intention would move the market against them. Dark pools let large institutions trade privately, protecting them from predatory traders. But darkness corrupts, and absolute darkness corrupts absolutely. By 2012, over 40% of stock trades happened in dark pools. Nearly half the market, hidden from public view. What started as protection for institutions became a hunting ground for predators. Here's how the game worked. Your broker receives your order to buy Microsoft at $60. Instead of sending it to a public exchange, they route it to their own dark pool. There, your order might match against the broker's own inventory, or against a high-frequency trader who pays for special access. You never know what price you could have gotten elsewhere. You never know who's on the other side. Some dark pools went further. They gave high-frequency traders special order types unavailable to regular participants. These exotic orders could detect incoming trades and react before execution. Like playing poker where certain players can peek at your cards before betting. Barclays' dark pool, one of the largest, was caught lying to clients. Marketing materials promised protection from predatory traders. In reality, they were inviting those very predators in and giving them advantages. The SEC fined Barclays $70 million, a slap on the wrist for a crime that generated billions. The real victims were investors who thought darkness meant safety, mutual funds trying to buy stocks for retirement accounts, pension funds managing teacher savings, all routed into black boxes where the rules were hidden and the game was rigged. Brad Katsuyama's team discovered their orders were being systematically disadvantaged in dark pools, sent in at one price, filled at another. Always worse, never better. The pattern was too consistent to be chance. Dark pools had become the perfect crime scene. No witnesses, no transparency, no accountability. Just an endless flow of orders being quietly robbed, penny by penny, in the darkness. But Brad had seen enough. If the system was designed to steal, he'd designed something different, something radical, something fair. Chapter 6. The Psychology of the Hunt. Every predator studies its prey. In the Serengeti, lions learn the patterns of zebra herds. On Wall Street, algorithms learn the patterns of human traders. And you, with your hopes and fears and cognitive biases, are the easiest prey of all. High-frequency trading isn't just about speed. It's about psychology, about understanding how humans react to price movements and exploiting those reactions. This is where your channel's expertise becomes crucial, because the real edge isn't in the technology. It's in the manipulation. Consider a common scenario. You see a stock breaking out. Volume surges. Price pushes through resistance. Every instinct screams, buy. So you do. Instantly, the volume disappears. The price reverses. You're trapped. What happened? You fell for an algorithmic illusion called momentum ignition. Here's how it works. An algorithm detects low liquidity in a stock. It starts buying aggressively, creating the appearance of a breakout. Chart patterns form. Technical indicators trigger. Retail traders see the opportunity and pile in. The moment enough real orders enter, the algorithm reverses. It sells into the buying it created, profiting from the artificial move. The volume was fake. The breakout was fake, but your losses are real. Or consider spoofing. An algorithm places large orders just outside the current price, creating the illusion of support or resistance. Traders see these levels and adjust their strategies accordingly. But the moment anyone tries to trade against them, the orders vanish, like ghosts that exist only to manipulate perception. These aren't glitches, they're features, designed by teams of programmers and psychologists working together to map human behavioral patterns. They know you fear losses more than you value gains. They know you chase momentum. They know you trust visual patterns. And they've coded all of it into machines that never sleep, never tire, and never feel mercy. The most insidious part? These practices blur the line between legal and illegal so effectively that enforcement becomes nearly impossible. Spoofing is technically illegal, but proving intent in a system executing millions of trades per second? Good luck. You're not competing against other traders anymore. You're competing against algorithms designed to exploit the very cognitive patterns that make you human. Algorithms that can process information faster than you can see it. That can place and cancel orders faster than you can click. That can detect your intentions and trade against them before you even realize what's happening. The market hasn't just been computerized. It's been weaponized against human psychology. Every emotional reaction you have, every pattern you trust, every instinct you follow has been studied, quantified, and coded into systems designed to transfer money from your account to theirs. But one man decided the hunting had to stop. Chapter 7. Building the Speed Bump. Brad Katsuyama faced a choice: accept the corruption as unchangeable, or build something better. He chose to build. Leaving RBC meant walking away from millions in guaranteed compensation. His friends called him crazy. His parents worried about his future. But Brad had seen too much. He couldn't participate in a system designed to steal from the very investors it claimed to serve. He gathered a team of believers, technologists who understood the plumbing, traders who'd felt the sting, idealists who thought markets should be fair. Together, they designed something revolutionary, an exchange that was intentionally slow. The concept was elegantly simple. If speed was the weapon, they'd neutralize it. Every order coming into their exchange would be delayed by exactly the same amount, 350 microseconds. Less than half a millisecond, but enough to ensure no one could race ahead. They called it IEX, the Investors Exchange, and the centerpiece was a speed bump, 38 miles of fiber optic cable coiled in a box. Every order had to travel through this coil, adding precisely the same delay. Geography became irrelevant. Physics got neutralized. The playing field leveled. Wall Street's reaction was volcanic. Major exchanges filed hundreds of pages of objections. High-frequency firms threatened boycotts. Critics called it anti-innovation, anti-progress, anti-American. The attacks revealed their fear. If IEX succeeded, it would prove their entire business model was unnecessary. But Brad's team pushed forward. They published their specifications openly. No hidden features, no special order types, no payment for order flow. Every participant, from giant pension funds to small retail brokers, would be treated identically. The transparency was radical and threatening, because it highlighted how opaque every other venue had become, How many conflicts of interest were baked into the system? How much money was being siphoned from real investors to parasitic intermediaries? When IEX applied for official exchange status, the battle intensified. The SEC received thousands of comment letters. Industry giants spent millions lobbying against approval. The hearings were contentious. The vote was close. But in 2016, IEX became the first new stock exchange approved in a decade. The speed bump worked exactly as designed. Orders couldn't be gamed. Prices were stable. Investors got fair execution. It was proof that markets didn't need predatory practices to function, that fairness and efficiency weren't mutually exclusive. Today, IEX handles billions in daily volume, not because it's the fastest, because it's fair. Because sometimes the solution to a high-tech problem is surprisingly simple. If everyone has to slow down, no one has an advantage. But IEX was just one exchange in an ocean of venues. The war for market fairness was far from over. Chapter 8. The Retail Revelation. For years, retail traders blamed themselves. Bad timing, poor discipline, emotional decisions. The losses were always internalized, always personal. But what if the game was rigged from the start? The truth is brutal. From the moment you click buy, you're at a disadvantage. Not because you're slow or stupid or emotional, because the infrastructure itself is designed to extract value from your orders. Start with payment for order flow. Your commission-free broker isn't free. They sell your orders to high-frequency trading firms. In 2023 alone, this practice generated over $3 billion. That money comes from somewhere. It comes from you in the form of worse execution prices. Here's how it works. You place an order to buy Tesla at $200. Your broker sells that order to Citadel or Virtu. They execute it at $199.95 and sell it to you at $200. You got your price, so you don't complain. But you never knew a better price was available. Multiply that by millions of trades, and the theft becomes staggering. Then there's internalization. Your broker might not even send your order to an exchange. They match it internally against their own inventory or other client orders. They decide the price. They control the execution. You have no idea if you got a fair deal. The fox is guarding the henhouse, and you're the hen. Smart order routers add another layer of extraction. These systems supposedly find you the best price across all venues. In reality, they often route to venues that pay the highest rebates to brokers. Your order takes a scenic route through dark pools and wholesale markets, getting picked off at every turn. The complexity is intentional. If you understood how your orders were really handled, you'd be outraged. So they hide behind technical jargon and regulatory disclaimers. They point to best execution requirements that are so vague as to be meaningless. They claim they're reducing costs while secretly harvesting billions. Even worse, your behavioral data is being weaponized against you. Every order you place, every pattern you follow, feeds into databases analyzed by machine learning systems. They know when you trade, what triggers your decisions, how you react to losses, and they use all of it to trade against you more effectively. You're not a trader in this system, you're a data point, a source of order flow, a pattern to be analyzed and exploited. The market isn't serving you, it's feeding on you. The saddest part? Most retail traders never realize what's happening. They see the losses as personal failures. They buy more courses, try new strategies, blame their psychology. Meanwhile, the real problem is structural, systemic, and completely hidden from view. But awareness is growing. The GameStop saga of 2021 exposed some of these practices to mainstream attention. Regulators are finally asking hard questions, and traders like you are starting to demand better. The revelation is simple but powerful. It's not your fault. The game really is rigged, and once you see it, you can't unsee it. Chapter 9. Following the Money. Who profits from the millisecond heist? Follow the money, and the picture becomes clear. This isn't a victimless crime. Every penny extracted comes from somewhere, from someone. Start with the high-frequency trading firms, companies like Citadel Securities, Virtu Financial, and Jump Trading. These aren't household names, but they should be. Virtu famously had only one losing day in 5 years of trading, not because they're prophetic, because their strategies are essentially risk-free. Their profits are staggering. Citadel Securities generates over $7 billion in annual revenue. Virtu makes hundreds of millions in profit. Jump Trading's founder is worth billions, all from shaving pennies off trades. Your trades. The exchanges are complicit. NYSE, NASDAQ, and others generate hundreds of millions selling speed advantages, co-location fees, proprietary data feeds, complex order types. They've turned their venues into casinos where the house always wins and speed is the only currency that matters. Brokers play their part. Robinhood made over $1 billion in payment for order flow revenue before going public. Charles Schwab, TD Ameritrade, E-Trade, all participate. They advertise commission-free trading while secretly auctioning your orders to the highest bidder. Technology vendors cash in too. Firms selling microwave towers, laser communications, and specialized hardware, the arms dealers in the speed war, every microsecond shaved off latency is worth millions to their clients. But where does all this money come from? Simple. It comes from real investors, pension funds managing retirement savings, mutual funds investing 401k contributions, individual traders trying to grow their wealth. Every one of them pays the invisible tax. Academic studies estimate the total extraction at tens of billions annually. That's money that should be going to retirements, college funds, and personal savings. Instead, it's funding yachts for high-frequency traders and bonuses for exchange executives. The wealth transfer is massive and mostly invisible, hidden in the microseconds, disguised as liquidity provision, justified by complexity. But the flow is always the same direction, from those who invest to those who intermediate. The defenders of this system claim they're providing a service, tightening spreads, adding liquidity, improving efficiency. But efficiency for whom? When a pension fund pays more for shares so a high-frequency firm can profit from latency arbitrage, who really benefits? The truth is uncomfortable but undeniable. An entire industry has been built on extracting value from the investment process without adding any. They're not allocating capital. They're not discovering prices. They're not financing innovation. They're just very sophisticated middlemen, taking a cut from every transaction, and the cut keeps growing. As technology advances, as strategies evolve, as new venues emerge, the opportunities for extraction multiply. Unless something changes, the heist will only get bigger. But change requires awareness, and awareness starts with you. Chapter 10, The Awakening Giants. For years, the regulatory system seemed hopelessly captured. The SEC, FINRA, CFTC, acronyms that promised protection but delivered theater. But something fundamental is shifting. The giants are finally waking up. The GameStop saga of 2021 was the earthquake that shook them awake. When retail traders coordinated to squeeze short sellers, only to have brokers shut down buying, the manipulation became too obvious to ignore. Congressional hearings followed. Public outrage exploded. For the first time, payment for order flow became headline news. The aftermath revealed cracks in the fortress. SEC Chair Gary Gensler, himself a former Goldman Sachs partner, began questioning practices his predecessors accepted. Payment for order flow, he noted, is already banned in Canada, the UK, and Australia. Their markets function fine. Why should American investors accept less protection? International pressure is mounting. The European Union's MiFID II regulations brought unprecedented transparency requirements. Singapore tightened rules on dark pools. Even China cracked down on high-frequency manipulation. The U.S. market, once the gold standard, now looks like the Wild West by comparison. The fines are getting real, not the slap-on-wrist theater of the past, but penalties that actually hurt. Citadel paid $700 million for misleading clients. Robinhood faced billion-dollar lawsuits. The cost of corruption is rising, and that changes behavior. Technology is democratizing detection. Academic researchers now use machine learning to identify manipulation patterns. Retail traders share suspicious activity on social media. Whistleblowers leak internal documents. The darkness that enabled theft for decades is being pierced by thousands of small lights. New voices are entering the conversation. Young regulators who grew up with technology, politicians who understand algorithms, journalists who can explain complex fraud in simple terms. The old guard's monopoly on narrative is breaking. Even more encouraging, the industry itself is fracturing. IEX proved that fair markets are viable. Other exchanges are experimenting with auction mechanisms that reduce speed advantages. Some brokers are abandoning payment for order flow voluntarily, using transparency as a competitive advantage. The data is becoming undeniable. Study after study quantifies the extraction. MIT researchers documented billions in latency arbitrage. Federal Reserve economists exposed the true cost of fragmentation. The evidence mountain grows too high to ignore. But the real change is cultural. The acceptance is ending. Retail traders no longer blame themselves for systematic disadvantages. Institutional investors question why they pay for liquidity that vanishes when needed. The social license to steal is being revoked. Yes, the system remains tilted. Yes, the thieves still profit. But for the first time in decades, the trajectory points toward justice. The cops might have been asleep, but they're stirring. The question is whether they'll wake up fast enough. Change doesn't happen overnight, but it's happening. In committee rooms where new rules are drafted. In courtrooms where precedents are set. In boardrooms where compliance officers finally have power. In trading rooms where fairness becomes profitable. The regulatory capture that seemed permanent is proving temporary. Because every system, no matter how corrupt, eventually faces its reckoning, and that reckoning has begun. Chapter 11. The Double-Edged Sword. Technology created this problem, but technology might also solve it. The same forces that enabled the millisecond heist are evolving in ways that could either entrench the theft forever or finally democratize markets. The future is being written now, and it's not yet determined who will control the pen. Artificial intelligence is already reshaping the battlefield, but not just for the predators. Retail traders now have access to AI tools that can analyze patterns, detect manipulation, and execute strategies previously reserved for institutions. Apps like eToro and Public.com use machine learning to educate users about order flow and execution quality. The knowledge gap is narrowing. Blockchain technology promises radical transparency. Imagine a market where every trade is recorded immutably, where order flow can't be hidden, where payment for order flow would be visible to all. Several startups are building decentralized exchanges that could eliminate the middleman entirely. No more dark pools, no more hidden fees, just buyers meeting sellers directly. Even quantum computing, terrifying as it sounds, could level the playing field. When quantum computers become commercially available, they won't just be for Wall Street giants. Cloud-based quantum computing could give retail traders computational power that today costs millions. The speed advantage might become irrelevant when everyone can process at quantum speeds. The real game changer might be collective intelligence. Reddit's Wall Street bets proved that coordinated retail traders can move markets. But imagine that coordination enhanced by AI, informed by shared data, protected by encryption. Thousands of small traders sharing information in real time could match the pattern recognition of any algorithm. Open source is joining the fight. Developers are creating free tools that detect spoofing, analyze order flow, and identify manipulation. What once required million-dollar systems can now run on a laptop. The weapons of the heist are being democratized and turned against their creators. Regulators are finally embracing technology too. The SEC is building systems that can analyze millions of trades for manipulation patterns, machine learning models that can detect spoofing in real time, surveillance that operates at the speed of the crime. The cops are getting faster cars. Even traditional finance is adapting. Major brokers are experimenting with blockchain settlement. Exchanges are testing AI-powered surveillance. The industry knows change is coming, and some are choosing to lead rather than resist. But the most powerful technology might be the simplest: connection. Social media turned individual traders into a collective force. Platforms like Twitter and Discord allow instant sharing of market intelligence. The crowdsourced detection of manipulation is faster than any regulatory system. The high-frequency traders aren't standing still. They're developing new weapons, new strategies, new ways to extract value. But for the first time, they're not the only ones innovating. The arms race has become multi-sided. The danger is real. Technology could create markets so complex that only machines can participate, where human judgment becomes obsolete, where the extraction becomes so sophisticated that we don't even recognize it as theft. But the opportunity is equally real. Technology could create markets so transparent that manipulation becomes impossible, where every trade is fair because every participant can see everything, where speed advantages disappear because information moves at light speed for everyone. The next decade will determine which future we get: It depends on who builds the tools, who writes the rules, and who demands change. The technology itself is neutral. It's a sword that cuts both ways. The question is, who's wielding it? Chapter 12. Breaking the Chains. You've seen the prison. Now let's talk about escape, because while the system is rigged, you're not powerless. Knowledge is the first step, action is the second, and collective action, that changes everything. Start with your broker. Ask them directly. Do you sell my order flow? If yes, how much do you make? Which firms buy it? What advantages do they have? Most brokers will deflect, but ask anyway. Document their responses. Share them publicly. Shame is a powerful motivator. Consider switching to brokers who don't sell order flow. Yes, you might pay commissions, but visible costs are better than invisible theft. A $5 commission is cheaper than systematic poor execution hidden in the spread. Route your orders intelligently. If your broker allows, direct orders to IEX or other venues that prioritize fairness. Avoid dark pools unless you understand exactly how they operate. Demand transparency in how your orders are handled. Time your trades differently. High-frequency algorithms are most active during the first and last 30 minutes of trading. They feast on volatility and volume. Consider trading during quieter periods when the predators are less active. Use limit orders religiously. Market orders are invitations to be robbed. Limit orders force execution at your price or not at all. Yes, you might miss some trades, but you'll also miss being systematically exploited. But individual action isn't enough. This is a collective problem requiring collective solutions. Share this knowledge. Every trader who understands these mechanics is one less victim. Every investor who demands fairness adds pressure for change. Support political candidates who understand market structure. Most don't. Educate them. Payment for order flow is banned in Canada, the UK, and Australia. Their markets function fine. Ask why American investors deserve less protection. Join investor advocacy groups. Better Markets, the Healthy Markets Association, and others fight for structural reform. They need support, funding, and voices. Your voice. Document your experiences. Every suspicious fill, every stop loss hunted by pennies, every pattern that suggests manipulation. Build the evidence base that forces action. Most importantly, reject the narrative that this is just how markets work. Markets are not natural phenomena. They're human constructs that can be rebuilt. The current system wasn't inevitable. It was chosen, and what was chosen can be changed. The high-frequency traders want you to feel helpless, to accept the theft as the cost of participation, to blame yourself for losses their system creates. Refuse. You're not failing at their game. Their game is designed for you to fail. Real change happens when enough people say enough. When the cost of maintaining corruption exceeds the profits it generates. When transparency becomes non-negotiable and fairness becomes profitable. You can't beat algorithms at their own game, but you can refuse to play. You can demand better. You can support alternatives. You can spread awareness until the darkness has nowhere to hide. The chains are invisible but real, woven from fiber optic cables and coded in algorithms, strengthened by complexity and defended by profit. But every chain can be broken, and it starts with traders like you refusing to accept that being robbed efficiently is the best we can do. The choice before you. They built tunnels through mountains to save 4 milliseconds. They arrested programmers to protect market-manipulating code. They created dark pools where half of all trading happens in shadows. They turned the stock market into a speed game where physics beats fundamentals and algorithms hunt human emotion. This isn't conspiracy. It's documented reality. In SEC filings that detail exchange revenue from selling speed. In court cases that expose the power of trading algorithms. In academic research that quantifies the billions extracted through latency arbitrage. In the frustration you feel every time a trade goes against you the moment you enter. The evidence surrounds us, but it's fragmented, scattered across technical papers and regulatory documents, hidden behind jargon and complexity. They count on you never connecting the dots, never seeing the full picture, never realizing that your trading losses aren't always your fault. But now you know. You've seen how latency becomes profit, how darkness enables theft, how psychology gets weaponized, how the entire infrastructure of modern markets has been optimized to transfer wealth from investors to intermediaries. The question is, what now? You could pretend you never learned this. Go back to blaming yourself for every loss. Keep feeding the machine. Keep playing a game designed for you to lose. Comfort is always easier than change. Or you could act, not by trying to beat them at their own game, that's impossible, but by demanding better, by choosing brokers who don't sell order flow, by supporting exchanges like IEX that prioritize fairness, by sharing this knowledge with every trader you know. Because here's the truth about rigged games. They only work when most players don't know the rules. Every person who understands payment for order flow is one less victim. Every trader who recognizes spoofing is harder to manipulate. Every investor who demands transparency weakens their advantage. The high-frequency traders want you focused on chart patterns while they profit from the cable patterns. They want you studying technical analysis while they perfect technological advantage. They want you managing your psychology while they mine your behavioral data. But the greatest trades aren't made in markets. They're made in minds. And once you understand how the game really works, you can stop playing theirs and start playing yours. This investigation revealed an uncomfortable truth. The market isn't broken. It's functioning exactly as designed. Designed by those who profit from complexity, opacity, and speed. Designed to extract value rather than create it. Designed to transfer wealth from millions of small accounts to a handful of large ones. But design can be changed. Markets are human creations, not natural laws. What humans build, humans can rebuild. The heist continues every millisecond of every trading day, but it only works in darkness. You now carry the light. What will you do with it? Right now, as you process what you've just learned, high-frequency algorithms are executing millions of trades, extracting millions in profits. From pension funds, from retirement accounts, from traders just like you, the millisecond heist never stops. But your participation in it can. Have you ever felt that sting? That moment when your perfect setup instantly reversed? When your stop loss got hunted by pennies before the stock rallied? When every trade felt like someone was reading your mind? You weren't imagining it. You were experiencing the system working exactly as designed. Designed to harvest your orders, decode your patterns, and profit from your reactions. If this resonates, if you've felt this frustration, type exposed in the comments. Not for algorithm engagement, but as a declaration that you see the game, that you refuse to be silent prey, that you're ready for markets that serve investors, not exploit them. This isn't about becoming a better trader. It's about demanding a better market, one where speed doesn't trump fairness, where darkness doesn't enable theft, where technology serves price discovery, not price manipulation. Share this investigation with every trader you know, your colleague who keeps losing and doesn't understand why, your friend who thinks the market is pure and fair, your family member who trusts their retirement to a system they don't understand. Because knowledge is power only when it spreads. Every person who understands these mechanics is one less victim. Every trader who sees the truth weakens their advantage. Every voice demanding transparency brings change closer. Subscribe to Trading Psychology Stick, not for hot tips or magic indicators, but for continued investigations into the hidden forces shaping your trades. We'll keep exposing the systems designed to transfer wealth from your account to theirs. We'll keep fighting for fairness in a game rigged against you. The market's predators evolved in darkness. They profit from complexity. They depend on your ignorance. But evolution works both ways, and an informed trader is a dangerous trader. You now know about the tunnels and the algorithms, the dark pools and the speed games, the psychological warfare and the systematic theft. You can't unknow it. The question is what you'll do with it. Will you keep playing their game, or will you help build a better one? The next millisecond starts now, and for the first time, you're trading with your eyes wide open. Welcome to the resistance.